Hi there and welcome to the Stock Club podcast. I'm James, and with me this week is my Wall Street co-founder and chief investor, Emmett Savage, our head analyst, Rory Curran, and our financial analyst, Anne-Marie Kingsland. Today, we're talking about why Netflix's disappointing subscriber growth shouldn't concern investors, our thoughts on the recently IPO'd company UiPath, and if our opinion has changed on Palantir since it first went public last summer. So guys, we actually have a celebrity in our midst today, Emmett, after your big appearance on CNBC on Monday. I actually wasn't sure you were going to turn up to our humble podcast today.
Yeah, how do we book him?
How do you get rid of me?
Who's your agent? Who's representing you now?
Well, Emmett, one thing I did notice was that on the last podcast, you said that you never prepared for Stock Club, and you seemed pretty prepared for CNBC. So I'm just kind of curious about how much prep you actually put into this outside competitors show.
Well, you're right. Well, the first thing is CNBC is live, so you better have your facts down. Whereas at least if we fluff something here, we can go, hey, let's do that again. Although I have to say, in our 50 plus podcasts, we've almost never done that. But anyway, yeah, I was well prepared. And as the interview was on Monday, I spent a large part of the weekend studying Tesla's last few quarterly earnings calls. But as Street Signs is a topical show, it's all about the now. So I didn't really get a chance to say, that thanks to advances in autonomous driving and wireless charging, I think that someday it will make sense for Tesla not to sell cars at all.
Yeah.
I had a bigger picture view, but really the whole piece was about, so what do you think Elon's going to say in 10 hours or whatever, in 5 hours, whatever the time was?
Well, see, Emmett, that's the difference here. You can say it on a show like this. We have a bit more creative space on a show like this.
I think we figured out how to get him to prep, James.
That's it.
We'll just Bill O'Reilly it.
Well, Emmett, you were talking about Tesla's upcoming earnings report, and the company has since reported. Was there anything that stood out to you in the results?
Not especially. I mean, they reported their 7th consecutive profitable quarter. They moved 185,000 cars, which is about twice the number sold at the same time last year. They made about $438 million profit, which is 39 cents a share, which, as the piece on CNBC zoomed in on, was aided in large part from selling regulatory credit sales. So one thing is that Tesla sells as many carbon credits as it wants or as it needs in order to produce a profit. And it really, for me, feels like Amazon, where I think Rory, many podcasts ago, said something to the effect of that Jeff Bezos is like, if you're going into competition with Jeff Bezos, feels like going diving, deep sea diving with him. He has the biggest oxygen tank. And with Tesla, they can decide how profitable they want to be in the next quarter by the number of carbon credits they sell. Yeah. So really the story that we're handed at the end of each quarter is far less relevant to the big picture.
Absolutely. Well, we spoke about earnings there, so let's move on and talk about Netflix, which of course is one of the first kind of big tech companies to report their earnings last week. It made for pretty dismal reading, however, with a massive miss on new subscriber additions reported in the first quarter of the year, 4 million versus an expected 6 million, and only 1 million net additions forecast for the current quarter. While a lot of this might seem like a worry for investors, Netflix stock down almost 10% since the report. The company is having success elsewhere. On Sunday night, for example, the studio won 7 Academy Awards for movies like Ma Rainey's Black Bottom and Mank. Emmett, you're the resident Netflix bull here in MyWallSt. What are your thoughts on the company's differing fortunes on the books and then on the screen?
Yeah, well, Netflix and Tesla are my two biggest holdings, and on any day they're neck and neck. So on any day, I'm the one probably with the biggest interest in them, certainly in MyWallSt. So just as you said, Netflix today is a $226 billion business, which, just to frame, I always like to frame these things by benchmarking, because we are, I suppose, creatures of benchmark. So that's about twice the size of Diageo. It's about the same size as Nike, and it's about 1/3 the size of Tesla. So just to kind of frame how big is Netflix today, and that's kind of some benchmarks. And as you said, the numbers, they were a mixed bag. So their earnings per share were awesome. They did $3.75 earnings per share, which is, as most of our listeners know, is the bottom line profit per individual share. And so $3.75 earnings per share versus $2.95 expected. So that's obviously fantastic. They did revenue of $7.16 billion in the quarter, which is pretty much in line what the consensus opinion was. I think 7.13 was expected. But really, the global net subscriber additions were just shy of 4 million versus an expectation of 6.2 million. So that was where the shock or the body blow was delivered. And to quote directly, they said, "We believe paid membership growth slowed due to the big COVID-19 pull forward in 2020 and a lighter content slate in the first half of the year due to COVID-19 production delays." So what they were saying is that they don't believe competition. They added that they don't believe competition played a factor in the weak subscriber numbers. And we know, like, the competitive landscape has absolutely changed. It's unrecognizable to where it was 3 years ago. We've Disney Plus and Hulu and HBO Max, Apple TV, Amazon Prime, Comcast have NBC Universal's Peacock, I think it is. So there's loads and loads of competitors. But what they said is that they expect to spend more than $17 billion cash on content this year. So bringing it to your point, James, which is, you know, the fact that they did very well at the Oscars, it's clear that the story of Netflix is changing, and it's changing in two ways. One is that, previously the story was principally about subscriber growth. Now it's about margin growth, and it's about filling the trophy cabinet with Oscars and related accolades that kind of put them, like, they're already a vertical player. They're a vertical player entirely inside the home entertainment, but now they're producing the best of content right through to getting the Oscars and distributing the movies. Rory, were you going to say something?
I think
there?
it's I think, like, you mentioned a lot of, like, the good stuff that came out on the call, and we know, like, Netflix always has these quarters. I think they have them pretty much once a year where there is this drop or this miss in subscriber numbers, and it's always the same story. It's always this pull forward, and it comes obviously through the lockdown. That was a major issue. People were desperate for entertainment and were signing up to Netflix at a faster rate than usual.
Yeah, sorry, just to add some context to that. They actually pulled in 16 million subscribers in Q1 last year, which was, you know, obviously they seemed like one of the big first winners of the COVID-19 lockdown, and maybe this is just the kind of the hangover from the initial boost.
Yeah, I mean, like, it happened. Like I said, it happens all the time. It happens sometimes when they release shows earlier than expected. You know, I remember Stranger Things 2 came out a few months earlier than expected, and the following quarter they had a problem with subscribers where they hadn't met the numbers that they expected. Funnily enough, one of the things that, you know, when we talk about competition, the competition landscape has changed a lot. We just got Alphabet's numbers last night, and what great numbers we saw from YouTube, which is now a $6 billion business. And they said the growth for US adults during the pandemic went from 73% of all adults to 81% in 2021. So YouTube has suddenly entered the game. And, you know, with Netflix, it's always a competition for eyeballs. I think he once said his biggest competitor was sleep. There's definitely a lot more places for eyeballs to go now. But still, I mean, looking at the business as a whole, there was still some great numbers there. Focusing on subscriber growth doesn't look that great, but, you know, revenue was still up 24%. Price increases don't seem to be, you know, handling churn as much as we thought they might do. And they've got some great stuff lined up, as you said. They've even got, I think they announced yesterday, a new animation with Lin-Manuel Miranda, which, you know, if they're going after that Disney Plus audience, that's definitely going to get them some subscribers.
Well, speaking of competitors there, you know, we mentioned YouTube's incredible performance of the last quarter, and Disney notably were the second biggest winner at the Oscars on Sunday night. Are we still confident that the kind of streaming landscape is not a zero-sum game, that there is enough room for all of these massive companies that are all backing this massive growth over the next few years?
I think so. Like Frances McDormand, when she accepted the Oscar for Best Actor, she kind of asked the viewing world to get back to the big screen. I think she said, please watch our movies on the biggest screen available to you, which is, I suppose, her extending the worry of the entire industry, which is that that very landscape that you described, James, has utterly changed. The way we consume movies now, we've been forced into a new habit, and going back into a big theatre is something less likely even when the doors swing open again.
Yeah. Absolutely. Anne-Marie, before we started this podcast, you made a point that it's perhaps becoming very difficult for traditional studios to compete with the likes of Netflix, not just in terms of viewership numbers, but in terms of actually getting top talent on board. Why do you think that is?
I guess I can just kind of see within the future that the types of films that are going to be produced, I think they're going to be pushed out towards the extremes. I think we're going to see very expensive traditional IP films being produced by massive studios like Disney, for example, which now controls Marvel and Star Wars and all of its kind of traditional IP that it's going to recreate into live action movies. We saw that this year with Mulan, which was a massive release and pushed a bunch of people onto Disney Plus. And then I think the second cheapest way for these streaming services to get content, rather than producing it in-house, is to buy up distribution rights for smaller independent films. So we talk about Nomadland, which won Best Picture this year. That was an independently produced film. I think it was made for something like less than $5 million. And then Hulu purchased the streaming rights, and Hulu is controlled by Disney. And so I think the opportunity for creatives is very much going to be, you either need to make the cheapest movie you can possibly make, or you need to get inside one of these gigantic production companies and kind of work within the machine to make a giant film. I think we're going to see a considerable squeeze for kind of mid-level studios, for example, something like Paramount, like Lionsgate, like MGM, who have attempted to keep their content exclusive to themselves and release it through their own much smaller streaming platforms. So, for example, MGM is with Epix and Lionsgate is with Starz. But I really don't know, are smaller streaming services like that going to survive up against Disney and up against Netflix? And so I can see in the future that we will see massive studios like Disney beginning to buy up smaller studios, much like what happened about 10 years ago with music labels, where we went from about 6 major music labels to 3 as they began to eat each other alive, basically. So I think that is going to definitely change the types of content that we're going to have, because there are just going to be fewer people for artists to bring their content to.
Yeah, absolutely. And I think from the consumer side as well, the big thing I'm certainly noticing after the past year is that with all the different services I'm signing up to, it's way more expensive than any cable bill ever was.
Did I tell you my story about my friend Kate? Actually, no. I didn't. I was going to tell you my story about Kate when Bumble IPO'd, but didn't get around to it. Well, she met a guy who she thought was really nice and respectful. But guess what he asked her to do at the end of the date? He asked her to share her Netflix login and password. Stranger danger. I mean, big time. Anyway, I presume Netflix heard about this. Hold on, no, wait. So Netflix must have heard about this because they're testing a crackdown on password sharing, and their COO, Greg Peters, I think, said that the company is working on making sure that people who are using Netflix account are the ones authorized to do so. But anyway, then the boss man, Reed Hastings, said, we test lots of things, but we'll never roll something out that feels like turning the screws. But honestly, I was listening going, you heard about my friend Kate on Bumble. That was just out of order. No way.
I had no idea where that was going.
Yeah, that's a story you definitely wouldn't get away with on CNBC, Emmett. Let's move on then quickly. So 2021 has been a bit of a blockbuster year for IPOs already, with the likes of Bumble, as Emma's already mentioned, Coinbase and Roblox all hitting the public markets. Last week we saw what was reportedly the third biggest software IPO on the US markets, UiPath. Rory, you've been looking into UiPath and even wrote a first look report on them for the MyWallSt app. What are your initial thoughts on this company?
Yeah, well, they are very much initial thoughts, because I hadn't actually even heard of the industry that UiPath kind of operate in until I kind of started looking at them. UiPath, went public last week. They actually ended up IPOing for less than their previous funding round, but since then the stock's been bought up by investors, and now it's sitting at around a $37 billion market cap, which was around where it was kind of pitched at when their last private funding round came in. It's in the RPA game, which is robotic processing automation. And anyone who has ever used Microsoft Excel will be kind of familiar with this idea, which is if there's a kind of task that's kind of repetitive or menial, you could write a macro formula in Excel, which will basically let the computer do it all for you, and you can create large data sets and models through that. And that's been available since around 1987, whenever Excel was launched. But RPA it kind of allows companies to do this on a much larger scale and lets them do it across multiple applications. So if you're one of those people who's ever, I suppose, whenever you're working as an intern or ever you were a junior in a company, you'd typically be given a job where you basically have to just get like a big, large data set and transfer it across an application, and it's time consuming and boring and menial. And, you know, those kind of jobs can now be very much automated and are being automated by companies like UiPath. And what it's doing is it's essentially allowing an awful lot of large companies to eliminate their reliance on what's called BPO, business process outsourcing, in which tasks like document processing and data entry are essentially outsourced to countries with lower labor costs. Places like India, for example, have a very big BPO industry. At the moment, 8 of the Fortune 10 and over 300 of the Fortune 500 clients use UiPath in some respect. And it's a very high dollar base net retention business, so 145% over the last 12 months. And this kind of shows, we always like to see this in software companies, it shows that what they're providing their clients is valuable, and that clients are spending more with them year over year because they're finding new ways of using it and they're finding value in the product. They're getting return on investment from it. The company has seen very robust revenue growth, up about 81% in fiscal 2021. On top of that, they have very high gross margins, about 90% gross margins. Now, they're not yet profitable, but we're seeing signs of operational leverage across the business. Now, interestingly enough, 40% of the company's revenue is categorized under maintenance support. And that it hasn't dented gross margins, but it's something that I would find a little bit worrying, because that would imply to me that the software isn't as user-friendly as maybe people think it is when they sign on to this product. If 40% of their revenues are coming from having to contact the company and get them to help out with this software, there's obviously something going on there where they need to, I don't know, make it easier or make it more user-friendly for the business. And in the whole kind of RPA space, Ernst & Young, a consultancy company, found that 30 to 50% of deployments end up failing due to organizational confusion or IT debt issues. So it sounds there that there's a big opportunity for something like a good enough product that could come in and possibly not be as complex as UiPath, but would get the job done. And that could possibly undercut them on price, which enter Microsoft, because Microsoft have recently launched an RPA product which is definitely not, nowhere near as robust as the UiPath platform, but has a very distinct advantage of being free for anyone who uses Office 365.
When I was reading the report, Rory, I was getting real Slack versus Microsoft vibes off this. Yeah,
you're definitely going to get some Slack versus Teams ideas of this. And what we found with the Slack Teams rivalry was that companies were very willing to take a product that wasn't quite as good. It wasn't the kind of best-in-class product, but because it was free, it was just good enough. And not only does Microsoft have that, it has the previous relationships with business and has great distribution through all its resellers. So there were kind of the two big takes I took from looking at UiPath. It's also got kind of competitive pressures from companies within the RPA space. There's another company called Automation Anywhere, and there's another one called Blue Prism. Now, Blue Prism seems, as far as I can read, to kind of fallen behind the other two in terms of their product development, but Automation Anywhere has been noted as being more cloud ready than UiPath. So there's a little bit of there's good things and bad things to look at the business. Like I said, it's the first time I've even looked into this industry. And I suppose it all kind of rests on this idea of how far are these guys along in terms of AI? How far along is it before these products are working the way they're supposed to work? And it's not just constantly calling people to sort out the problems that they haven't been able to figure out. And that'll get better, as they expand users and they get new use cases. But at the moment, its valuation is pretty high, 60 times sales. Now, obviously, you've got that robust revenue growth, but are we going to see that maintain after the pandemic? Because we know an awful lot of these companies have been looking into stuff like this with users working remotely. So interesting business, a lot of things that we'd like to see in a business. It's founder led. The guy's high insider ownership, was founded in Romania. I think it's the first company I've ever looked at that began life in Romania. Yeah. And they seems to have kind of a happy workforce, rapid revenue growth. So a lot of ticks in the boxes, but yeah, again, valuation very high.
I also noticed that the founding CEO, Daniel Dines, has the largest, he controls 88% of the voting power, because they created two classes of share, and I think their B shares have 35 votes per share, where the A shares, which are the ones that are listed, have just one vote per share. So I think we're basically looking at a business that whatever Daniel Dines wishes goes.
That's obviously a concern for investors, Emmett, is it?
It is, yeah. I mean, it's good to have insiders with interest and with a meaningful stake in the business. But when it's a kingdom, in this case, what the king says goes, and Dines now with 85% of the voting power, 88% of the voting power. Means really, well, we just hope that he's a good guy. I don't know anything about him. I presume he's only going to act in the business's best interest. But whatever opinions we have on matters to do with voting doesn't really matter, because at the end of the day, what he says is the last word.
Yeah. We've seen this before with dual class share ownership, and I suppose this is the first time we've seen it brought to a kind of the absurdist final end of what's, where it's going to go, where someone just owns the entire company forever, and there's nothing we can really do about that.
Let's move on then. And millionaires across the country were crying into their top hats last week after Bloomberg reported that the Biden administration was planning on hiking up the amount of capital gains tax they would have to pay. Officially announced this morning, just an hour before we started recording, so we really didn't have much time to prep this. The proposed hikes under the American Families Plan Act would see the US households making over $1 million, which is the top 0.3% of all households, according to the White House, paying the same 39.6% tax rate on all of their income, including returns on investments. Just for context, the current rate of capital gains tax for this group is about 20%. Emmett, well, it's quite early, or it's a bit early to see what the effects of this will be. Last week, when the rumours about this came out, we saw a lot of panic on Wall Street, and the indexes suffered as, I suppose, people pulled their money out of the market. What are your thoughts on this? How will this affect, I suppose, the ordinary retail investor?
Well, as I've always said, I'm no economist, James, so thank you for offering me the chance to prove it in public. Well, you see, most individuals who manage to better their situation through investing, of which I'm one, land on a gripe with the fact that every investment they ever made was after paying tax. And then they forewent to pleasure, invested their savings, and then at a later date found that they're going to be taxed yet again. Yeah. So they're taxed at the start, they accept all the risk, and they're taxed on exit. So, rather than just announce that I think CGT is a disgrace, I disappeared down a rabbit hole to research it. And, I conclude that the balance between income tax and CGT, capital gains tax, is an incredibly complex equation that appears to have been introduced with a light amount of research, as I said, in the US in 1913 and refined in virtually every country in the world ever since. So, capital gains are, and I've opened Wiki right here. It says capital gain taxes are disproportionately paid by high income households since they are more likely to own assets that generate the taxable gains. So that makes sense. But what CGT is, without any doubt, is an obstacle to a sale. So capital remains tied up that otherwise would flow in an economy. If CGT is perceived as too high, the asset owner will decide, I'm not selling it. And actually, JT and I, my co-founder, and I had a chat with a business owner, a building owner in the middle of Dublin City, who was left at a kind of a crown jewel location property by his father in his will. And the gentleman we were speaking to was mature in years and had no interest in selling it because he had such resentment to the CGT tax level in this country. So, he'd rather go to the grave than pay CGT, which I suppose is an anecdote that illustrates it is an obstacle to a sale.
But in some respect, then, is capital gains tax a good thing because it encourages people to hold on to stock investments, particularly longer? Totally.
I think so. I mean, as much as it's an annoyance to me, it has accidentally made me do some really good things. As I've said in the past, I've been a shareholder in Netflix for 17 or 18 years, and there were times I'm pretty sure where the CGT stopped me from selling. Yeah. But I think what we're looking at with Biden's announcement, or the White House announcement this morning, is that 997 out of every 1,000 households in the country will not be affected by this tax.
Yeah.
So to your very first question, what does it mean for the average woman and man on the street who is trying to better their situation? And the answer is, for the vast, vast majority of people, it means nothing or very, very little. So, I didn't, and I thought that the street's reaction it surprised me a little bit, because when the rumor, hit the wire, the market responded positively, which is typical of the inverse logic we see a lot of these days, where when what would have once been considered bad news is kind of upended and becomes good news, because people were expecting something, and now that the negative news is out there, they know what they're dealing with.
Rory, I saw you were making a joke on Twitter about the fact that over here in Ireland, you were laughing at American investors worrying over this, seeing as over here in Ireland we pay much higher capital gains tax rates.
Yeah, well, it's hard to kind of feel any sympathy for them for the millionaires anyway, when we pay a regressive tax rate across the board, which isn't time bound in any way. So there's no incentive for younger people who haven't got vast amounts of income to invest. There's no incentive for them to hold over the long term. And I'm kind of upset he didn't actually go further with this and perhaps start moving it out further, where, people under a certain income bracket would pay very little tax if they held for something like 5 to 10 years, because that's really how you end up building generational wealth amongst people who haven't, inherited a fortune, who weren't born in the top 5 to 10% of the population. But yeah, look, it's a move in the right direction, I suppose. Yeah,
I saw Chamath, Social Capital's founder, reacted to Biden's proposal by suggesting how there should be a sliding scale on CGT. And he said that less than 1 year, the CGT tax should be 75%, and it slides outwards. So after 10 years, there's no CGT whatsoever, which, would highly incentivize us as long-term investors to stick by our resolve. But I'm afraid Biden didn't pick up on that tweet, and the news is out now.
I think
he'd have made very little off those Virgin shares, I suppose.
Meow.
I think one of the biggest takeaways is probably a lot of cryptocurrency millionaires realizing that there is actually such a thing as capital gains tax, and realizing I actually have to pay money on this.
Yes, actually, I was speaking to one of them before the pandemic broke out, when we were in MyWallSt HQ. Someone came in to me, and he had made, through any barometer, a fortune on Bitcoin. He was just a full-time coder who understood the trend way before the rest of us. And I mentioned CGT to him, and he actually had never heard of it, didn't even know what I was talking about. Well, so there is a generation of new millionaires, I suppose, who haven't even figured yet that they owe tax. And the real risk is, if they don't pay it when it's due, it starts to accrue interest. And when eventually they realise, or the local taxman realises, trouble's afoot.
Yeah, it'll be a pretty rude wake-up call. So let's move on then and take a quick check-in on what's going on in MyWallSt at the moment. We're coming towards the end of another month, which means that there's a new Stock of the Month report, a new Stock of the Month podcast, and a brand new stock edition in our shortlist at the moment. You can also get access to loads more great investing insights, including Rory's first look report on UiPath and Anne-Marie's recent update on the incredible turnaround of Chipotle Mexican Grill. Plus, May's Stock of the Month selection will be added to the app this Monday, May 3rd, and it's one you really don't want to miss out on. It's only members of the MyWallSt community that get access to all of this great stuff, so if you want to check it out, just tap the link in the notes for today's show and start your free trial. Jargon Busters, Emmett, I'm going to come to you first. And 2 weeks ago we were hitting some big news that Stitch Fix CEO and founder Katrina Lake was stepping down from her role. We added Stitch Fix to the MyWallSt shortlist just over 2 years ago, and I know you were a big fan of the company, particularly its AI recommender system. Has your opinion changed on Stitch Fix now that Lake is departing, Emmett?
I think it's a pity she's leaving. The world needs a founding CEO, a female founding CEO who's brought something from inception through to mega heights. Now, it already is at mega heights, but I'd rather she have stayed. We like founding CEOs irrespective, but I think Katrina Lake was a really great figurehead for the business, and she was a great woman in leadership. So I think it's a pity. Yeah. So yeah, it causes me pause. Yeah, for sure.
Yeah. Okay, cool. Thanks for that. Here's a question that came in via the MyWallSt app from Joseph. He asked, what stocks would be a hedge against the growth stocks in the current environment? Rory, any thoughts on that?
In terms of hedging, if you're not going to go down the kind of derivative path, the only kind of way to kind of hedge is the wrong word, but the only kind of protect your way against a drop in high growth stocks is just not own too many of them. The diversify your portfolio a little bit, and I think if you're going to be one of these investors who holds only high growth tech stocks, you are going to have to deal with the volatility that comes with it, and that can, as we've seen in the recent past and further afield, can be very painful at times. You can see your entire portfolio drop 20-30% in a matter of a couple of days. So it's not that difficult a thing to build into a portfolio a couple of more slow growers. Peter Lynch reckoned there was 6 type of different stocks. There's plenty of companies that are a bit more stable but still grow at great speeds. Things like Google, for example, Amazon, are all in the tech industry as well, but still manage to grow very fast over the period of a year without seeing these kind of 20-30% plummets. If you're gonna end up on the kind of lower side of the scale with companies that are small cap or mid cap, prepare yourself for that kind of volatility, because that's what you're dealing with. That's the way you get that kind of incredible growth number that people have seen in 2020 when their portfolio grew 2-3x over the course of a year.
You recommended the Home Depot as stock of the month back in December. Would stocks like that be another way of kind of diversifying your portfolio away from growth stocks?
Yeah, I mean, as we've talked about before, there's loads of different ways to diversify your portfolio through market cap, through industry, through geography. Through market cap is one way where you can easily diversify your portfolio and have some big hitters as kind of anchors of your portfolio, things that hold the whole thing together when the market's reacting badly. Companies like Home Depot are great like that. Companies like MasterCard are great like that. There's a whole host of businesses. Nike, another great example of businesses that are growing year over year. These are not slow companies that don't do anything. They're just large, so they don't get the same kind of 2x returns every year, but they're still growing, they're still attributing to your portfolio. And when the market goes a bit wonky, when there's a sector rotation, for example, you're not going to feel like your whole world's collapsing. You're going to have something there that's keeping the whole boat afloat, some ballast in the ship, if you will.
I've just noticed here that Home Depot is actually up over 20% since you picked it back in December, so maybe it's unfair to say it's not a growth stock. You heard it here first. The last question we got is...
It's a slow growth stock.
By the way, James, I actually, and not too long ago on Twitter, asked a question that said something like, if you were to buy only one stock with a market cap below 20 billion and hold it for the next 30 years, what would you choose? And that kind of forced people to come back with, the more rational people to come back with businesses that at least will still be around in 20 or 30 years. And actually, Bill Mann, a pal of mine from the Motley Fool, an absolute master investor, responded with a company that I hadn't really given any attention to, and it's called Watsco, WSO is its ticker. It's very interesting for anyone who's really looking for a low-risk way to invest. It pays a really great dividend, and I think has a great future, and it keeps outperforming quarter after quarter. So that's just a name that I think is worth looking at.
What do they do?
I think they air conditioning servicing.
Okay, yeah.
I think that's what they do. It's very unglamorous, but it's nonetheless. They distribute air conditioning, heating, and refrigeration equipment and related parts and supplies in the United States, Canada, Mexico, and Puerto Rico.
Sounds fascinating. Let's move on then. The final question we got in is from Paul, asking about our thoughts on Palantir. Rory, I know you'd been looking at Palantir around the time it went public late last summer. What are your thoughts on it now? Yeah,
so before it went public, I looked at the S1 and I read quite an interesting article. I was in the New York Times magazine called Techie Software Soldier Spy, which is a great long read and kind of looked into the business from that journalist point of view anyway. And in that article, she kind of pointed out a couple of issues that Palantir had been having, and notably that there was an awful lot of kind of pilots that they launched that had just been total failures. One called Metropolis, which was designed for financial institutions, was noted to be an unmitigated failure. There was a joint venture, Credit Suisse, that was there to kind of police the bank's own employees, that was called, in air quotes, a complete bust. And I'd been working on a number of projects with the police forces that you would think would kind of be a natural evolution from Palantir's kind of cornerstone work with the US military, but none of that had kind of come to fruition.
Yeah.
And a term that kept coming up in that piece was this idea of RFOP, which stands for room full of people. and it got into this idea that in terms of data, in terms of storing data and looking at data, it's only really worth investing if the program works by itself. You know, if you're relying on a room full of people to constantly come in and clean up the data, similar to kind of what we talked about earlier with UiPath, if you're relying on the company keeping come back to keep working the system over, then it looks a lot more impressive than it actually is, and you end up kind of, you know, keep investing money into it over and over again to try and make it work. I've kind of looked a bit more closely at it now, and as a company, I can see signs of where it is breaking away from that idea. You know, it's, as we know, companies are dealing with this massive explosion of data, causing huge problems because they just don't know what to do with it. It's often siloed across various parts of the organization. It's very hard to combine historical data sets in a way that makes them readable, or in a way that gives you a holistic view of your operations. And now the company still does seem to have problems in terms of how many of its pilot programs actually make it to fruition. I think there was a report by the Standish Group. Now, this again came out during the P1, where it said only 12% of large and 5% of organization-wide platforms were ever deemed successful. And gave an example of the US military, which one of the US military agencies, which spent over $1 billion building an ERP system from scratch, and this project was never delivered and unsuccessfully concluded. So, but there is kind of things you can see with Palantir where they have a system where they send engineers to different industries during every time. So each time they're building up a knowledge base of ways to tackle various problems. And in terms of, you know, one example is they developed a feature for the oil and gas industry, which was retooled for the medical industry when it came to allocating protective equipment during the coronavirus pandemic. They've got a partnership with called Skywise with Airbus, which connects over 100 airlines, 15 different suppliers, and 9,000 aircrafts in integrating flight engineering and operations data. And that it seems is taking down the amount of time it's taking to implement these systems, and it is making them a little bit more cost effective. Still not totally sold on the business. There's plenty of things not to like about it, I think. The CEO, he's obviously a very good businessman. He's one of those people I don't think you'd want to go for a beer with.
No.
But, you know,
and there's not many of them, Rory.
That's true with me anyway. I'll go for a beer with anyone. I'm still on the sideline. I'm more inclined towards it than I was at the time of the S1, because I'm starting to see suggestions that it is more than just a room full of people, that they are developing systems that are letting it scale properly. And I'll take a closer look at it, because it has just kind of passed that point where we would consider it to add to MyWallSt.
Okay, cool. Thanks for that, Rory. So let's get on to the elevator pitch before we end today's show. So Anne-Marie, you survived your first elevator pitch last week. You've survived for another week, so we're going to give you another go again. And I believe you have pretty unexpected stock to pitch us here.
Yes, I have. I'm pitching a stock, but I guess more importantly, I'm kind of pitching a consumer trend that we can all take a look at. So I am going to pitch Burlington, which is, its stock symbol is Burl, B-U-R-L. It used to be known as the Burlington Coat Factory. It's apparently been rebranded since I was last there to buy my communion dress. And its kind of most famous, I guess, pop culture moment was referenced in an episode of The Office one time. And Michael Scott said, if you go to Burlington Coat Factory with $645, you are literally a king. And so it's one of these kind of off-price discounted retailers. It would be similar to TJ Maxx or Ross or Marshall's. Burlington is the kind of smallest version of these stores. And the reason I like it is because it kind of took a calculated risk at the beginning of the pandemic. So in March of 2020, the company made the decision to permanently close down its website, which just seems completely counterintuitive to the kind of context of the pandemic. But the reason it decided to do this was before the pandemic, it was only bringing in less than 1% of their sales. And I think that Burlington was very good at kind of identifying what its strength was that these stores are all have different inventory because they kind of buy up excess from designers. They buy up stuff that traditional department stores don't want or can't sell. And so it means that there's a constant inventory turnover. In most department stores, inventory sits for months. In a Burlington, it can sit for maybe 6 weeks before it gets turned over again. And so it means that there's a really random selection. And kind of this last quarter, we saw Burlington really kind of taking advantage of the fact that maybe the antithesis to e-commerce is this kind of treasure hunt shopping that consumers are interested in. We talk about like the strength of Etsy is the fact that people can go on there and find kind of items that no one else can have. They're all really unique. They come from artists. Burlington is kind of the in-person version of that.
Yeah.
And they're kind of riding a considerable wave after the pandemic because when these department stores began to close down, they stopped ordering from a lot of major designers. And so now designers have a massive backlog of items that they've produced over the last year that they're just basically handing out to retailers like Burlington. And so in their last quarter, they are basically back to their pre-pandemic numbers, and their top line was 4% higher. And they, in 2021, plan to open 62. In 2020, they opened 62 new stores, and they plan to open 100 more in 2021. That being said, the stock is up 100% in the last year, so a lot of people are taking notice.
Oh, what isn't? Come on, that's nothing.
I know, yeah.
They must have been one of the only retailers actually opening stores last year.
Yeah, they definitely were. And it has caught people's attention, most definitely. But I think that it and its kind of contemporaries, TJ Maxx, Ross, and Marshalls, I think are going to ride a kind of trend wave as we begin to enter the pandemic. People want to go into stores. They want to look for individual items. And the only place to kind of do that is these places. And I think it's the exact same trend that is causing people to be really interested in purchasing secondhand items. It's because they want to find a sweater that somebody's grandmother has had for 40 years, and so that they can wear it and look like Harry Styles. And so I think Burlington should continue to have success in kind of the next year to 2 years.
Absolutely.
What
That's
a pitch.
great
They
pitch.
should re-release that thrift shop song.
Yeah.
Maybe not. I would prefer if that didn't come back out, to be honest. So that's it from this week's Stock Club. Don't forget about all the great new stuff in the MyWallSt app at the moment. If there's anything you want us to discuss or explain on the next episode, make sure to get in touch. You can find us on Twitter, that's at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club, and if you're enjoying the podcast, please leave a review for us on whatever platform you listen to us on. That's it from us here today. We'll talk to you in 2 weeks. Happy investing.